Welcome, Anders. It feels like it's been a couple of weeks since we had our last update, and we have a whole lot of very interesting things to talk about. If we start with the US, we have a lot of moving parts going on there. Everything from we've had some government shutdowns, we've had discussions about inflation, difficulties cutting rates by the Fed, lots of talk about tech, both results and tech bubbles and deficits and money surpluses from the tariffs, and the list just keeps going on and on and on. So how do we put these pieces together and make some sense of it?
Well, I do think fundamentally the US is in really good shape. The economy is driven by a 2% productivity increase. We have a contribution from investments at almost a percentage point to GDP growth. There has been massive investments in AI, and it's fairly likely that those will start to give big results in 26, 27 and going forward. I don't think Fed are that worried about inflation. It is at 3%. Tariff was the dog that really didn't bark. We're talking about a couple of tenths of percentage point of an impact on inflation. So whether Fed cuts the rate in December or January, I think is of kind of minor importance. They are heading towards down to neutral rates. If they would cut rates in December, that would be good. If they are abstaining, they can do that with a dovish tilt so that the market understands that the rate cut is fairly likely in January. So the inflation outlook and monetary policy is supportive, and I think the health check that we did in the Q3 results was kind of spectacular. We had a sales growth of almost 10% now where we have most of the results. We had an earnings per share growth of 15%. And we also got this week the Nvidia result. And I mean, that's a universe of one. You have to remember Jensen Huang's quote. The sales outlook is AI in everything, everywhere, all at once. So there is a sales growth of 60%. There is an earnings per share growth of 60%. It's a company worth twice the German stock market that is actually delivering growth like it was a startup with spectacular margin levels of 50% on EBITDA. And I mean, the outlook for the Blackwell cells next year looks to be very, very impressive. It seems to be heading towards almost the size of Swedish GDP. So yeah, there is a lot going on in the US on technology, and AI is leading the charge, but we see a very broad investment in new technology in the US, and I do think that the US is heading for a pretty good 26. It's fairly likely that you will have a nominal growth that provides a foundation for sales growth at, let's say, 6 to 7%. And profit margins expanded in Q3, and it looks fairly likely that they will continue to expand into 26. Energy costs are lower, interest rates are lower, productivity is eating into wages. So all the cost factors that used to weigh on profitability is actually improving. And on the back of increased capacity utilization and a tighter output cap, companies get pricing power back, and we could also see a bit of fixed cost impact at higher capacity utilization. So I think there is a fairly solid foundation for the US moving into 26 with some strength.
Mm. If we turn and shift a little bit to Europe, then I guess we've seen the Q3 results. We have while we have still falling inflation, we also have quite weak growth. What do you see for Europe coming up?
Well, I mean, the best description of Europe is that we're seeing a normalization. So growth is coming up to, let's say, close to 1.5% next year. That's obviously not very spectacular, but it's much better than 25, particularly if we look at Germany, France, and Italy. There are some support for growth. ECB has cut rates, and maybe they can deliver one or two more cuts. We see that investments are picking up on a much lower level than the US, but it's improving. A very important factor is that wage growth seems now to come down to very moderate levels. ECB wage growth tracker is now hovering around 2%. We've also seen employment slow a bit, which is implying that productivity might come up. to slightly below 1%. And that would imply that unit labor costs actually are creating a gateway for ECB to cut rates at least once or twice more during next spring. So if you look at Q3, the results are not anywhere close to the US. Sales growth is close to zero. EPS growth is close to zero. We see a bit better numbers coming out of the industrial sector, very important for Sweden. But then we're talking of growth levels of around 3%. So Europe is normalizing, but the fundamental risk of Europe going into a deindustrialization and the perma-stagnation, I think, is one of the most important risks for Sweden, for Europe, and obviously for the global economy. Europe doesn't have the energy. It is 50% higher energy prices in Europe than the US, and obviously also higher than China or India. And at the same time, we see spectacular cost differences to for example, than China. So Europe is in a place where you need some really deep structural reforms, and the likelihood of those reforms are pretty low. So if you look into 26, you have a normalization growth at 1.5. Given that European stock markets have a sales composition that is fairly different from US, we sell 20% to Asia, 20% to the US. Nominal growth for companies will pick up a bit, both in real terms and nominal terms in 26. And I do think that we have some laggard sectors that could actually see a bit of real growth push. And I think the industrial sector, being very important for Sweden, is one of those that actually have a bit of tailwind going into 2026.
You mentioned China, you mentioned India. For emerging markets, we've seen a lot of resilience and also good growth. What's driving the performance in emerging markets, and how do we see that shaping up for 2026?
I really think there is a very strong case for emerging markets. If you just do the fundamentals, nominal growth is between 8 and 10%. India is growing 6-7% in real terms. Now inflation is below 2, but maybe we should expect it to pick up to 3% next year. China is obviously growing slightly below 5, and not much inflation, but picking up a bit next year. The whole ASEAN region with Indonesia, Philippines, etc. are growing very, very strongly. So on overall, you have a very solid foundation for sales growth. We have to understand that these countries are very different from Europe. There is a fast ongoing urbanization that is growing faster than the average GDP. We have a middle class growth that is also higher than average growth. So it is fairly reasonable to find companies delivering sales growth in the neighborhood of 10 to 15%. There are a couple of factors that could also drive margins. The companies that are listed are normally further out on the high end of the productivity curve, and productivity increases normally implies higher margins. There are moats. These are markets where it's somewhat more complicated to enter, and that provides a bit of also support for profitability. So with really strong net sales growth and fairly high margins, the emerging market region is very reasonable. If you look at valuations, they are pretty moderate right now. There is a good case for margin expansion. Margin expansion would come if you improve governance, reduce macroeconomic instability, reduce risk premium for currencies, if you improve rule of law, if you get a deeper domestic market. And I think the best outlook for the next 5 years is that most of these boxes will be ticked. And in terms of technological leadership, I think it's important to understand that China is in the driving seat, not on the most advanced innovations, but in terms of business implementation and production implementations. The technological strength in Asia could not be underestimated. So yeah, I think the emerging market is heading towards a very, very interesting couple of years.
Well, we talk a lot about emerging markets and the case for emerging markets here at East Capital, and I think one of the latest articles that we had talked about the shift in emerging markets in terms of emerging markets are no longer seen as being a catch-up to developed markets. And if you look back at the last 10 years and then look forward, how do you see that?
I mean, if you go back 10 years and then look forward 10 years, the difference is very, very strong. The macroeconomic stability today is much better. Most of these countries run current account surpluses. Public indebtedness is substantially below Europe and US. Inflation numbers used to be fairly high. Now they've been very well anchored. In most of the cases, the central banks have gained independence over this time period. So I do think that a lot of the drawbacks that we've seen over the last 10 years, partly because of currency volatility, looks fairly different if you take a forward-looking view. It's pretty obvious that in the medium term, the dollar is at a high valuation point. There are current account deficits, foreign indebtedness that will weigh, and also public sector indebtedness that will weigh a bit on the advanced economies going forward. And those arguments clearly gives a better relative position for emerging markets. So I mean, it's difficult to do forecasts for stock markets, but if you can anchor a forecast in a roughly 10 to 15% net sales growth and a pretty strong case for margins in the neighborhood of, let's say, between 10 and 15, sometimes even above 15, that's a pretty solid ground for a stock market in the long run. And if you can buy that earnings per shares at a valuation at where the PE numbers are around 11, 12, yeah, I think that's a pretty convincing case.
For sure. We'll no doubt talk much more about that as we go forward. We would be remiss not to ask you about Sweden. So what do you see going forward for the Swedish economy?
Well, I think Sweden will not see a normalization in 2026. We will clearly see something that is, you have to call a recovery. Growth will be above 2%, could even go a bit up to 2.5% or something like that. So the EU Commission came out last week with a forecast where Sweden, of the advanced European countries, have the highest growth numbers. And I think that's a pretty solid expectation. Fiscal policy is supporting growth. Fiscal policy will support growth every year going forward because the debt dynamics and the tight fiscal regime creates a room to add spending and cut taxes every year in Sweden. So it's a case of its own compared to many other European countries. Monetary policy is expansionary. If my forecast is correct and the ECB is doing one or two more cuts, yeah, the Riksbank can follow a bit without getting into difficulties with the currency. The fundamental strength of the Swedish economy with I would say the best capital market in Europe. Just so we remember, the Swedish stock market is only half the size of Germany. So Germany has a population that is 5 times bigger, but the stock market is just twice as big as Sweden. This year we have had the same amount of IPOs as the rest of the euro area combined. For the last 5 years, we've had the number of IPOs that is equal to France, Germany, and Italy together. So the capital market is a really strong force in Sweden. And compared to the rest of the euro area, particularly Germany, Italy, and France, we have a very flexible labor market with well-educated people. We have unions that allow wages to be in line with productivity growth, also on a decentralized level. So I think there is a very strong bull case for Swedish economy. The Swedish stock market is overweight in industrials, banks, and real estate, so it's not driven by this spectacular tech growth. But if we see a European normalization on the industrial sector, I think Sweden is in a pretty good shape to outperform companies like Volvo, Sandvik, Scania, etc. are in great shape compared to their European competitors. So yeah, I think the Swedish stock market is in a pretty good place for 2026 as well.
Perfect. It sounds like there's a lot of really interesting things and exciting things for us to keep a lookout in all of the different markets, and we'll have to see how 2026 shapes up. But thank you very much for today's update, and we'll talk to you again soon.